Hey there, everyone. Happy Monday and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. Today, on today's show, our Monday market recap here on March 4th, we'll talk about really the overall conditions, which continue to be arguably quite strong, right? The most bullish thing the market can do is go up. The market seems continuing to do so. Now, today actually finished slightly in the red. Last 30 minutes, 40 minutes of trading really saw a brief downside rotation. The NASDAQ composite actually finished down about 0.4% after spending much of the day and certainly the afternoon session above zero. Some defensive sectors at the top of the list. So before you think SMCI is now a member of the S&P 500 here later in March, bullish, bullish, bullish. Let's remember that utilities and real estate, arguably the two most defensive sectors, were at the top of the leaderboard today. Some of the growthy stuff like communications services and consumer discretionary at the bottom of the leaderboard. So as always, there's plenty of evidence to consider on both sides. As technical analysts, as technically oriented investors, our burden, our job is to try to gather all of that evidence and try to draw conclusions about how we should be positioned based on the weight of that evidence. Let's do our part here to check on the progress of the markets here today and see what conclusions we can draw as we get to our market recap before we bring up the charts and look at that late day sell-off and what that might mean for the long-term trends. I do want to mention a poll we had going here over the weekend before the show. Do you currently own any sort of gold products? Yes, I own physical gold and or futures. Yes, but through ETFs. Yes, I own both ETFs and physical gold. And gold, no thanks. 56% of you said no thank you, no never, I'm not a gold person. And only 36% of you basically said you had either. Actually, that's not true. The math goes up to 44%, said you owned some sort of exposure to gold. I'm actually a little bit surprised by that, I guess, but maybe I shouldn't be. I remember with years in the institutional community, people were super allergic to owning gold, mainly because if you run a big equity mutual fund, investors don't buy your equity growth fund to get gold exposure. They'll buy a gold fund or something like that. And so owning gold was an out of benchmark bet you could rarely justify. But nowadays, what's so interesting is if you look at the chart of gold, it's actually quite strong here. The GLD was up 1.6% today. The chart of the GLD actually looks quite constructive here. And what's interesting about gold, as it's making a new 52-week high, and gold itself, spot gold, is threatening a new all-time high around above $2,100 an ounce. When you think about this breakout in gold, what you have to remember is the traditional relationship between gold and stocks is a story of relatively low correlation. And I can actually show you that chart at the bottom here. We're looking at the relative strength of gold to the SPY, but I'm going to change that from the relative performance to just the correlation. So here we're actually showing the correlation between gold and the S&P 500. I'm using the GLD and the S&P 500 index. Now you can see there are stretches where the correlation is strongly positive. We're actually getting closer and closer to kind of one of those periods because both gold and stocks are actually rallying. But if you look back, what's the average correlation between the two? I would say probably near zero, right? Because there are periods like November of last year, like summer of last year, like last winter, where the correlation is almost strongly negative, almost down to 0.7, 0.8, below zero. And so you have an asset that has a very low consistent correlation to stock. So we'd call that the unnecessarily complicated verbiage to describe that would be a diversified return stream is probably how I would describe that. But basically saying that gold does different stuff than stocks do. And that can be helpful when you're thinking about diversifying your portfolio, particularly now when it feels like everything is doing what the S&P and the NASDAQ are doing, right? It feels like all stocks are kind of going up and down. And they're not, by the way. We'll look at some ones that are sort of bucking that overall trend. But think about gold if you haven't been there. Potentially there's some opportunity, but certainly think about it as part of your normal process. That's something I would think about. Full disclosure, I do own GLD as I'm showing that chart to you. So let's get back to our market recap. All right, so let's go to the equity indexes. As you can see, the S&P 500 finishing the day right around 5131, just slightly below there. That's down 0.1% from yesterday's close. The NASDAQ composite down 0.4% to just above 16,200. Mid caps actually won the day, up 0.7%. Small caps lagged the S&P and the NASDAQ down 0.6%. So if you're looking at small caps and thinking, all right, this is the time when they break out, small caps are finally leading the way higher. Today's not that day. We're still lagging behind. And when we look at breadth here, if we have time permitting, the breadth on anything but small caps is pretty strong. The breadth on small caps itself kind of underwhelming right now. And there's a sector weighting issue that is small caps relative to large, but we'll get to that here in a moment. The VIX pushing a little bit higher, not by much. It bounced off a sort of 13 and the low 13s up to around 13 and a half. Again, below 14 or 15 is still by any stretch of the imagination a low volatility environment. When I think of volatility spikes, when I think about what a pullback would look like, and I won't say might look like, I will say will, because there will be a pullback, whether or not today's the beginning of it or not. A pullback will come, mark my words, and when it does, you will most likely see volatility spike. So when things feel overall pretty good, when you feel like the market is in a good bullish progression, think about those red flags. Like, what would you need to see that would say, okay, hold on, this might be something different? VIX getting above 14, certainly above 15, would raise a big red flag in my head. For now, we're not seeing that. Looking at interest rates overall, you can see the most of the yield curve basically moved higher. The 10-year yield is up around 422. 5-year yield slightly below there, around 421. The long bond yield, the highest around 436, we'll call it. Short-term yields, of course, the short end of the yield curve, that's near where the Fed is actually making changes if they would do so later this month at their March meeting. That would be the short end of the curve, still elevated relative to the rest of the curve. So we do still have that inverted yield curve, which many have spoken about. The dollar, not much index. And, again, thanks and a shout out to all of my friends in Dubai. What a fantastic journey to the Middle East. Flew right over to the North Pole, which is pretty cool. But being there on the ground, actually seeing Dubai firsthand, seeing the incredible growth, where the city started from and what's happened to it over the last 10 to 20 years, it's mind-boggling. It's staggering what humans are able to do when charged with doing so. And you can see the growth in that space. And also just some great conversations about global equities, about global markets, and that strength that we're seeing not just in the U.S., but in India, in Japan, in continental Europe, and elsewhere. And so one of the things we talked a lot about, actually came up a lot more than I probably would have realized, was the dollar, and just looking at the dollar as a potential gauge of inflationary pressures and everything else. For now, dollar stable, relatively speaking, from Friday's close. Looking at the commodity space, continuing to see more and more green. You're seeing the gold ETF GLD up 1.6%. The silver ETF SLV up 3.3%. I moderated a panel the first night of the conference with Gina Martin Adams of Bloomberg and Mohammed El Sayed, who is a technical analyst based in Egypt, widely known in the Middle East and covers those markets well, and certainly aware of the U.S. markets for sure. He actually made a really good point. I asked them just spot on about gold. He suggested gold quite constructive, but that silver is the most important thing to watch. A little more sensitive, a little more volatile, and so silver is sort of can be a bit of a leading indicator in his opinion. So had that in mind as I looked at the markets today and saw silver leading the way higher. So overall, that might be the ticker to watch, SLV. Crude oil prices coming off from Friday's close. The USO was down about 1.3%. Cryptocurrencies were all in the green. I sat down with our friend Adrian Zadunchik. We actually sat down next to each other for part of the conference. Great to chat with Adrian and spend some time with him, who we've had a virtual relationship for most of the time, but great to see him in person. We talked about just the long-term potential for cryptocurrencies, for Bitcoin, for Ethereum. And literally, as we're at the conference, you could get this sense of Bitcoin pushing higher. Hit 61,000 as we were there talking. Now it's up to over 67,000. This is causing Coinbase, the GBTC, and all of these other derivative products all moving aggressively to the upside. All-time highs are now within range. We're kind of right at that point if you look at the long-term chart of Bitcoin. Just to finish off our brief market recap here, I want to point out that utilities and real estate were your top two sectors. So before you think, all right, Monday was just a blowout, bullish, offense over defense kind of day, really wasn't the case. Utes were up 1.7%, followed by REITs, and materials number 3 from the top. At the bottom of the list, you have communication services and discretionary, both down around 1.33%, energy after that. Now there's some big names that really drag these cap-weighted ETFs down. Alphabet, Tesla are big weights in those first two, and those have not had particularly strong stretches here, and not a strong day either. Let's get to all of these charts in a little more detail here to finish off our market recap. And then we're going to do another segment called Getting Sentimental. We're going to focus a little bit on market sentiment today. Here's the S&P's chart. You might call this, I don't know if I'd call this a shooting star candle. You might actually call this a gravestone doji, which is always a fun one to get to announce that we're seeing here. Let's look at a little candle chart. See, I probably would label that a gravestone doji. That's where you have the open and close right about at the same levels, minimal lower shadow, a long upper shadow, as you can imagine by the fact that a Japanese analyst decades or centuries ago decided to call this the gravestone doji. Tells you probably what you need to know about the sentiment there. But again, think about what this actually represents. We opened at a certain point, we traded higher, we closed back at the lows of the day. That's usually a short-term reversal candle, so that's setting us up for a bit of weakness going into the remainder of this week. If you look, though, we're still holding above trendline support. This is that green trend line we've been keeping our eye on for the last couple months. Overall, as long as we hold above this, things just aren't getting that bad. We start to break below that trend line, which we did briefly here in recent weeks, but we've always gone back above it. Once we really break below that, that's when you immediately need to start looking down to identify some potential further downside support. The 50-day is right around 4,900. That would be the next logical pullback level I would probably be keyed in on, just at a high level looking at the S&P 500. Worth noting, by the way, we keep making new highs on weaker momentum. That's not my favorite feel of this market. Here Friday, we briefly became overbought. We came out of that overbought region just today. We'll see. I mean, it's still a little early on, I think, to declare this a top, at which point you could really assess that relationship. It certainly seems like we're moving higher on weaker momentum in that particular chart. I want to talk just briefly about breadth. I want to show the advanced decline lines just to highlight that the NYSE's advanced decline line, this is just a raw advanced decline data set. So this is New York Stock Exchange, large cap, mid cap, small cap. Now this is not yet updated for Monday's close. This is as of Friday's close. But I did want to point out that as of Friday's close, the NYSE, a pretty broad universe of stocks, the advanced decline line did finally make a new 52-week high, finally getting above that December peak. Now, I wouldn't be surprised if it might pull back a little bit here with today's session, probably not by much, but overall worth paying attention to because these lines breaking out are one of those things that should further validate upside potential in the S&P, right? When the market's going higher and there's better breadth, that's usually an encouraging sign. Now, note, the S&P small caps advanced decline line still neutral amber because we are nowhere near those previous highs. I think the small cap breadth has certainly been lagging behind the rest of these measures, just like the small cap indexes like the S&P 600 and the Russell 2000 have both been lagging behind the S&P and the NASDAQ. So that's continuing to be a phenomenon we're observing. In terms of new highs versus new lows, as of Friday's close, again, this is not showing today yet, but this is as of Friday's close, literally 18%, 90 companies in the S&P 500 made a new 52-week high on Friday. So when you see a chart like this, when you see how many more new highs there are than new lows, that is what a bull market phase looks like. Look for this to change, right? I always talk about a change of character. Look for green bars to go away, which would mean all these stocks that are making new highs, all of a sudden are starting to pull back a little bit. So you'll probably see the major benchmarks pull down a bit, but you see an evaporation in green, and that's basically, this is the engine, this is the momentum. These are the leaders that are pushing the S&P to new highs potentially. So if the green bars are gone, that means stocks are not making new highs. The new 52-week lows are pretty far away for a lot of stocks, so I wouldn't anticipate a lot of red on this chart until you get further deterioration. But for now, we're not seeing any sort of a red flag at the moment. Want to talk briefly here about Bitcoin because it keeps making new highs, and we're really close to making a new all-time high. And I do want to point that out here. So if you look at the chart of Bitcoin, I'm going to bring in a little more data because right now we're going back, oh, there we go. I was going to say, I thought I updated this chart to go back to the end of 2021. So there's your all-time high, right around 69,000, a little above there. We very quickly over the last couple weeks have gone from, we talk about breaking 50,000 as a significant level, breaking this last Fibonacci resistance. And the logic of the Fibonacci approach says that if you finally break through that 61.8% level, it says high likelihood you're actually going to do a full retracement back to the previous highs, which would give an upside objective around 69,000. Don't look now. We've actually gone there over the last week and a half, 2 weeks. Now, the upside is there. The momentum is quite strong. It's very overbought, but that is pretty common, particularly with Bitcoin, when you get in these extended bull runs. And when you look just recently when it's become extremely overbought, that's usually not the end of the move. At least you make another push higher even after initial pullback. So overall, I would say the structure of Bitcoin is still quite bullish. When you get very overextended, you'd anticipate a bit of a pullback, but we've not had pullbacks very often on the way up. Now, what happens when you have Bitcoin appreciating to this degree is charts like Coinbase really start to show the strength. GBTC, of course, is sort of a relatively direct bet on Bitcoin as a Bitcoin ETF now, but Coinbase sort of a derivative play. Of course, the chart of Bitcoin and Ethereum pretty much tells you what Coinbase is going to do because it's very much tied one to the other, but it is looking at the stock and the company itself and their earnings prospects, their possibilities to earn based on the strength or weakness of Bitcoin. So on your bingo card, your market bingo card, if you had the month of February that Coinbase would basically be a double from 115 up to 230 in about 4 weeks' time. Congratulations, you were spot on. I mean, it did not seem very likely as we're pulling back, making new swing lows, but that's certainly what's happened here. You can see we never became oversold here. We've now rallied. We're once again overbought. And again, when we're overbought, that means we've gone up a ton. It usually means we'll have a brief pullback when we come out of that overbought region. But overall, it usually happens more in a bullish phase. That's when the market gets up to that overbought condition. So I would say overall, a chart like Coinbase, pretty constructive. A couple other comments here to wrap up our market recap. 2 new additions to the S&P 500, and I missed the date. I think this is as of next week, next Monday, so check me on that. But it's not today, but it actually is. They usually announce it about a week before they make those changes. Super Microcomputer, SMCI, currently our second-ranked stock out of the entire large-cap U.S. equity, your U.S. listed universe, is being added to the S&P 500, up another 19% on that news, and that's just the latest move after this big run higher. We're now above 11. We're briefly above 1100. We're now pulled back just a little bit to around 1074, but overall, obviously quite a strong chart. This looks like a little move. This is a huge move from 350 up to 1075 or so. Super Microcomputer is number 1. Decker's Outdoor, DECK, is the second name that's being added to the S&P 500. You know which 2 stocks are being removed? Whirlpool, WHR, Zions, which is a regional bank, ticker ZION. So if you think about what's happening here, and this is what happens when you swap components in a major benchmark, we're adding SMCI, which is arguably one of the most euphorically driven stocks of all in the moment. Another AI play to supplement your holding, diversify away from NVDA. You can hold another big AI player. Deckers, which has just been in a fantastic uptrend here for over a year. And you're taking out an underperforming name like Whirlpool and an underperforming name like Zions. Benchmarks and benchmark providers are allowed to do that. Swap out names that are no longer working, swapping in names that are. That's a way that they say they're keeping the benchmarks updated. I would argue you're sort of, it's less and less of a relevant bucket of stocks, really showing the push and pull between stocks working and not working. You take out things that are really underperforming, you swap in things that are growing, and that's how the benchmarks overall remain probably stronger than you might expect. Just to finish off, a quick yin and yang within the Magnificent Seven. NVIDIA looks a lot like SMCI, it looks like this, but Apple, one of the other Magnificent Seven stocks, is not breaking to new highs. It's actually below its 200-day moving average, actually currently oversold with an RSI below 30. Amazon looks like this with a nice breakout above 145 and continued uptrend over the last couple months after that. Here's Alphabet, one of the other Magnificent Seven stocks, trading just below its 200-day. It actually closed slightly above it, but actually pushing to the downside. The reason why I'm going to show you this is, again, we generally think of things like the Magnificent Seven or the FANG. We think of them as a group of stocks. And at the time we sort of announce those monikers, they do tend to move in a similar way. And that's sort of why those acronyms come out, and that's why people tend to follow those. But what happens over time is they start to become disconnected. Tesla was probably the first to diverge from the rest of the Magnificent Seven. Now you see Apple, Google both breaking down, not making new highs, but actually making new swing lows. So if you look underneath the hood, I would say the Magnificent Seven not as strong as you probably would expect given that moniker. I would imagine we start to rotate and maybe swap in and out some names here, just like the S&P is doing, and clean up that group of leadership names, because some of these are not leading particularly well right about at the moment. Great reminder that when things are going well, when things are making new highs, that's when to update your risk assessment, update your stop losses. Don't wait for something to break down to then figure out what you're going to do about it. That's our market recap here from Monday, March 4th. Thanks again for joining us today. Before we get to our next segment, Getting Sentimental, just a reminder, we love to hear from you. We actually had a lot of great feedback in our survey. Thanks so much for those of you that took some time to share some thoughts with us. You can always get questions our way. We're going to do more mailbag shows here in the coming weeks, and we would love to answer one of your questions on the air. You can email us your question. That's always best, thefinalbar@stockcharts.com. We're on X. Just tag us in a comment @FinalBarSCTV. And on YouTube, of course, just drop a comment below the video you're watching. We would love to hear from you. I hope to answer one of your questions in our next mailbag segment. Let's continue on with our next segment today called Getting Sentimental. What I love to do on a Monday, check in on things like breadth indicators, sentiment indicators. Price is always most important. Don't get me wrong, right? So if you follow nothing else, follow price of an asset, price of an index. That tells you a lot of what you need to know. But then we have the benefit here in the US for sure with a very transparent market with a lot of depth and a lot of understanding of market depth and information to really assess the conditions of individual stocks, breadth conditions, and also sentiment data to help us just understand the sentiment and the psychology of other investors and when they may be betting too heavily on one side or the other. If you look at the VIX, which is $VIX, we're going to go through my sentiment indicator chart list, by the way. And if you are a Stockcharts member, you have access to all of these. I have a chart pack, and the way you find that is go to your charts. Go to your dashboard. Go to the bottom of your chart list. You'll find a little gray button that says Manage Chart Packs, and just install Dave Keller's morning coffee routine. You will get this group of charts along with a bunch of other ones. It'll give you some head start on using our Stockcharts platform. So looking at volatility, the VIX, and this is a thing we talked about often in Dubai. And again, I was able to moderate a panel that I presented with Julius de Kempener, who many of you, of course, know here at Stockcharts.com. We talked about sort of a good routine using rotational analysis, using the RRG, using traditional technical analysis, just walking through a general process of macro to micro using some of the charts we're interested in. And in the panel that I moderated, and it came up in a number of the discussions over the two-day event, was volatility and how volatility remains extremely low. And as I will tell you today, as long as the VIX remains below 14 or 15, this is a low volatility environment. Now, a low volatility environment does not mean that you can't change immediately, right? If the market if all of a sudden investors get completely freaked out, if all of a sudden some big news headline comes out that gives people the impression that the Fed will do something different or that they'll never lower rates again or whatever conclusion we draw, you will see volatility spike. But until volatility spikes, markets and investors essentially are just not that afraid of the conditions right here. The S&P at or near new all-time highs with the VIX around 13 is kind of a standard. If you ask me to write the story and the intro is the market's in a bull market, I would probably start with that sort of general assessment. The S&P is going up, breadth conditions are pretty healthy, and volatility remains low. And that is kind of where we're at here in early March of 2024. So I have alerts set as to when, if and when the VIX would break above 15. I have another alert set from when the VIX breaks above 20. By that point, I feel like I won't need an alert anymore because I'll probably be watching this like a hawk. But those are some of the alerts that I have set on my log, and I would encourage you to do something similar. And all that does is it just it lets the platform do some work for you and let you know when volatility spikes. Because if you look to the left, you can see when volatility is relatively low, and then we spike above that 14 or 15 level, that usually means we're in a bit of a pullback phase. Now, I pointed back here for a moment. What you have to remember is volatility changes, right? And we go through what I call volatility regimes. The VIX tends to settle into a particular range, which sort of describes the conditions in a particular market environment. Then something will change. We'll break out of that range, and we set a new range. And then the VIX will kind of remain about around there for 6 to 9 months. And then we kind of go to a new range, and then all of a sudden we reset. And for the last 8 or 9 months, we've been sort of in that 13 on the lower end, maybe 20, 22 on the upper end, and that's kind of where we're at right now. So with the VIX at the lower end of this range, it really tells us we are sort of in a consistent uptrend. If and when the VIX spikes, that's when you want to get concerned. VIX over 15 is where I would make a revisit of that chart, and I would encourage you to do the same. I did want to go through some of these sentiment indicators. These have not updated since last Thursday. These are usually weekly surveys that are updated. The AAII survey updates every Thursday around lunchtime Eastern, if I remember right. And basically is a question as to whether you are bullish, bearish, or neutral on stocks for the next 6 months. As of the most recent vote, actually the most recent vote was right there. It's 46.5% bullish, almost 50% bullish. Over 50% bullish is sort of the upper extreme. It rarely gets above that because you always have a healthy group of investors kind of always bearish, regardless of how good things would look, and usually voting that way. As of this most recent poll, there's around 21% bears. So the bottom panel shows you the spread between bulls minus bears, and you can see really since the week or two after the October low, right? So you had the major October low. We popped for a couple weeks. You can see we got up to around 20% difference between bulls and bears, and that's kind of where it's remained. Now it's pulled back a little bit here in mid-January, a little bit early February when you had these brief pullbacks, but overall we kind of keep coming back to that pretty healthy spread with about double the number of bulls than bears. So overall, this is pretty classic configuration in a bull market phase. What I would be looking for with this particular chart is if you see a big spike in optimism, right? What you're looking for is not just optimism, but euphoria. Not just that people are kind of bullish, but exceptionally, maybe overly bullish. When people get way overconfident that the market's never going to go down again, that's when you want to start questioning the persistence of the uptrend beyond that point. For now, it's still kind of okay, and you can see we're at similar readings that we've been really since mid-November of last year. So overall, no significant changes. I would say that's still a healthy reading on the AAII survey. Kind of an interesting rotation last week on the name exposure index. So this is updated I think this one's last Thursday as well. I forget when we get the data. I apologize, I don't know that off the top of my head, but sort of later in the week that I know we get it. 89% allocation to equities. This is one where it's basically asking a group of money managers, what is your allocation to equities? Coming in at 89%. Now, the week prior, which was the week before last, we were around 72, 73%. That came down quite a bit from like 95, 96% the week prior. So there was a big drop in the previous week's reading. Last week, which was last Thursday, if I remember right, when we get the data, it was back up to around 89%. So on this particular chart, again, similar to what we saw with the AAII survey, as long as it's healthy bullish readings, I don't have a problem with it. When it gets above 100%, which is basically leveraged long, when the net result of that survey is that these money managers are leveraged long, over 100% allocated to equities, that can be a sign of an overextended market. Now, I wouldn't make a trade just on that because you can see times where it gets to that reading and then we continue to go higher for quite some time. But it does tell me to look for signs of reversal. It does tell me that there's a lot of optimism already priced in, and I'm going to look for signs of deterioration, signs that maybe a lot of people might be caught on the wrong side of things, because that's when you can get a quick unwind. That's when it can go from over 100% down much, much quicker as investors quickly unwind a leveraged long position. That's what you saw here in June, July of last year. That's what I'd be looking for in this particular kind of environment, is a similar sort of reading where we become over 100% and then you see a quick snapback. For now, kind of healthy. Interesting one to finish off here, looking at the put-call ratios. And these are, again, looking at options data, similar to the VIX in that it's looking at the options market, but it's looking at different data. So here we're actually looking at put and call options, right? So a call option is, and again, I'm way simplifying here, but a call option is basically the right, not the obligation, to buy at a certain point. A put option is the right, not the obligation, to sell a particular stock or underlying security by a future point. And so when this ratio gets very, very low, that means way more calls than puts on the books, and usually means that investors are pretty bullishly positioned. That usually coincides with market tops. So if the idea that the market is so strong, investors are all bulled up, there are way more calls than puts, and that usually means this bullish trend is probably over. When the market sells off, you will see the put-call ratio spike higher. You'll see that going back anytime you have a big sell-off, you'll see the indicator go higher, because that means there are way more puts than calls, meaning a lot more negative bets, because the sell-off has gotten investors pretty bearish. So you're using this as a contrarian indicator, like the other survey indicators that I showed you earlier. Now look at the data, and you'll see that the put-call ratio is actually neutral, right? It's actually kind of right in the middle of where we've been. There have been, in this sort of phase when the market has been rallying so much, I would sort of naturally be looking for the put-call ratio to get very low as investors are making way more bullish bets, right? So you can see here in kind of November, December of last year, you saw the market rallying. All of a sudden, you saw the put-call ratio get very, very high, and that was a super negative bet. You can see when the market rallies, you see this ratio going lower, meaning way more calls than puts, and that's your contrarian sell signal because investors are way too bullish. You saw the same thing here. As the market went up, the put-call ratio went very low, implying investors were very bullish. That's a contrarian sell signal, and you expect a pullback. Now, we've had arguably a much stronger bullish phase than in those previous two examples I showed you, but instead of the put-call ratio being incredibly low, which would indicate a potential top in the market, you're not seeing that. You're actually seeing the put-call ratio be kind of neutral. That's the total put-call ratio, which means it uses index and equity options all mixed together. We have another separate data series, which is the equity-only put-call ratio. So it ignores the index options and basically just looks at underlying stocks, looks at equities. Same thing. I wouldn't consider this to be a particularly low reading. Now you have spiked down a little bit to around 0.5, which would be toward the lower end. But that's the raw data in gray. The 5-day moving averages here in pink. You can see we're well above the levels we were here in July, right? So you're not getting. I think back in July it was sort of the market rally, and you had the put-call ratios giving this clear contrarian sell signal because the put-call ratio was at its lowest levels than we'd seen in quite some time. You can see from these charts. I don't think we're seeing that here in early March of 2024. So what this might mean, again, I think the put-call ratios, I've used them less and less, to be honest with you, because in a world of zero DTDE options and the options market itself going through a lot of evolution here just in the last 12 months, what this indicator really represents in the new world where those are the most liquid options are very short-term options. I'm not sure how this is going to impact these indicators. Maybe we need to reset how we think about them. But using the traditional signals that I was taught, it's sort of neutral. It's not really giving you any contrarian sell signal. So that's how I would wrap this discussion called Getting Sentimental. We looked at the breadth data in our recap, and you could see how the breadth data was overall, strong but not excessive. Here we're seeing sentiment data, which is not overly contrarian sell signals just yet. However, keep an eye on these indicators because as the markets evolve, these data points will probably evolve as well. Make sure you update your alerts and make sure that you follow when those spikes may occur. Not happening just yet. Folks, we've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. As we were looking at stocks making new 52-week highs and 52-week lows in our market recap, again, looking at Friday's data, 90 out of the 500 stocks in the S&P, a full 18% making a new 52-week high. If that doesn't seem like a high number, it actually is. Look to the left, and you see it's incredibly rare for this many stocks in the S&P all making a new 52-week high on the single day. So when you have a market in this phase, which is undeniably bullish from a trend-following perspective, my market trend model is bullish on all time frames. I can't deny the price is going up. I would agree that that's the case. But these indicators turning less bullish can often tell you that whatever was driving this market higher is starting to slow down a little bit. We're not really seeing a slowdown yet. We'll see what happens when we get today's data points and through the remainder of this week. But I would keep an eye on this chart to see if we get a lot less green. And if so, that might be an indication of a market top. Chart number 2, the HYG. This is a high-yield bond ETF. HYG and JNK are two commonly used high-yield charts. I'm reminded of my conversations with Ms. Schneider. She often brings high-yield bonds up as a great measure of risk. A couple things I would note. Number one, it's very close to breaking out. When I think about the S&P and the NASDAQ making new highs, I am immediately drawn to things that are not making new highs yet. And then once those things start to break out, that would probably confirm the likelihood of further upside for the major benchmarks. HYG not quite doing it, really, really close. I would keep an eye on this chart because if we do get a breakout in high-yield bonds, that would arguably be another check in the continued bullish phase sort of checklist. Finally, we have some changes in our benchmarks coming up. We highlighted the change recently in the Dow Jones 30. Now we have the S&P 500, 2 changes coming up here later in March. Decker's Outdoor, one of the 2 stocks being added, along with a super microcomputer. Whirlpool, WHR, one of the names being removed. Just as a reminder, the S&P 500 is not a static group of 500 stocks. It changes. And a lot of times what a company like S&P will do is swap out something that's not particularly strong, swap in things that are stronger. So when you look at longer-term history in those benchmarks, remember, it's not the same bucket of stocks. It's actually a fluid, dynamic, rapidly changing group of names that evolve as the markets evolve as well. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. A shout out to all my friends in Dubai and from around the world. So good to see you in person, and thank you so much for watching. Don't forget to like this video, subscribe to our channel, and by the way, we hit 100,000 subscribers. No.